Good evening, everyone, and thank you all for joining. Let's just give it a couple of moments more for everyone to come in. Not expecting so many people today because it's half term here in the UK, but wherever you are, I hope that you're enjoying the sunshine as we are here. In fact, it's a little bit too hot for me, I've got to say. But only when he's sitting indoors, hey. So it's lovely to see. I can see lots of people joining here. Paul, lovely to see you. I thought you was on lockdown this week and avoiding us all, but lovely to see you. He's nodding away there, so at least I know you can all see me. That's good. Niels, good to see you as always. Joe, you're in the background there. I know lots of you, it's a little bit different timings because you're overseas, obviously, and lots more. It'd be difficult to mention you all, but thank you ever so much for joining us here. Good to see you. So I can tell that you can see me. If anyone can't, then just flag something in the chat, please. Send it to me directly, though, so that I can see that you're having some problems. Yeah, a few of you just giving me a wave. That's lovely. Thank you. So what I'm going to do, I'm going to jump on this straight away. Oh, what have I lost there? Dale? Yeah, right. Okay. Tech problems. I love a bit of live tech problems.
Is the slide back?
Yeah. Yes, it is back.
Okay,
it's
great.
Back. Thank you. So thanks, everyone. I think everyone's here. I'm just going to jump straight into it now. So we'll be running a Q&A session at the end, as always. So please do add your questions into the chat as we go. We will keep the webinar to a maximum of an hour and a half. And respect everyone's time value there. So any questions not answered in that time will be answered after the webinar during the day tomorrow. So please direct your questions to me in the chat so that I can see those and I don't miss any. And of course, it would be really helpful to me if when you're putting your question in, if you could just state whether it's for Dale, James or Liam. That would be really beneficial. So welcome to this Fabric Invest webinar, and thank you to each and every one of you for joining us. The topic for this webinar is an introduction to our expert panel, Fabric Invest, GetGround and Dicio Finance. We shall be going through the latest property market news, how to build a cash flow positive UK property portfolio, mitigate tax and maximise returns via a limited company, and much more. For those of you who don't know me, I'm Lynn Whittingham, and I'm delighted, as always, to be asked to host the webinars for the Fabric Property Group. For everyone who stays until the end of the webinar, we're giving away a free gift. Dale usually likes to increase these to 2 or 3. He always tells me there's 1, but there's usually more. So please do stop until the end for the opportunity to claim this. So without further ado, it gives me huge pleasure to introduce to you today from Fabric Invest, the Managing Director, Mr. Dale Anderson, from Dicio Finance, the Managing Director, Mr. James Brocklebank, and from GetGround, Mr. Liam Rogan. Welcome, gentlemen. Pleasure to have you here. And everyone, as always, you're going to be given extreme value from each of these gentlemen this evening. We partner with the best mortgage advisors and tax advisors, and I can highly recommend to you Dicio and GetGround. So let's start with you, Dale. Dale has over 15 years of experience in the property investment industry and a hugely trusted figure and well known for his honesty, integrity and professionalism. Dale has previously led and managed a team that sold 5,000 units and raised over £1 billion. Dale has experienced both the positive and the negative sides of property and certainly remembers the last property crash and how investors benefited. Dale's expert insights into the property investment market mean he's often featured in the media, as well as property news and magazines. Dale has also been interviewed by The Times, the BBC, the Daily Telegraph, to name but just a few. And it gives me great pleasure to also introduce you to James Brocklebank. James has worked as a mortgage advisor for over 10 years in a number of roles, starting in private banking and helping overseas investors and expats enter the UK market. Since 2017, when changes were made to the way buy-to-let properties were taxed, James has been predominantly working with portfolio landlords and those looking to incorporate their buy-to-let portfolios. James' specialism is assisting landlords to grow their portfolio and make the most of their assets and portfolios to ensure that they get the most cost-effective solution to their needs. In 2018, indeed, James won Mortgage Advisor of the Year at the Money Marketing Awards, no mean feat. And James is now the MD of Dicio Finance and has a team of advisors who are specialists in the off-plan buy-to-let arena. And also, if I can introduce you to Liam Rogan, who's I think the saying is a regular on the show. So some of you may recognise Liam. But Liam is one of the account managers for GetGround. He predominantly assists investors in the UK, Middle East and North African regions, whether they're UK real estate investments. Liam's work with real estate investors crosses the fields of technology, law, regulation and finance. He currently holds weekly online seminars to hundreds of investors in a variety of real estate forums to help educate investors as to the benefits of limited company structures and how to access them. He's based out of GetGround's London headquarters. So, Dale, if I could hand over to you, please, for the presentation. I'm going to let you run this for a moment.
Sure. Thanks, Lynn. Really appreciate the introduction, as always. Very warm welcome. And thanks for those who've taken the time to attend this evening. We hope you find value in the information provided. And as always, we're available to answer any questions after the webinar or throughout the week or weekends for that matter. So yeah, just as a quick roundup on what's going on in the market, there's been some interesting news recently. Zoopla have just released their latest UK housing price index, which was released on the 26th of May. So the question a lot of people have been asking, with the risks of COVID, lockdown, Brexit, how's the market going to perform? Are prices going to fluctuate? Are prices going up and down? So there's various factors to consider. And naturally, the whole world changed about a year ago with COVID and everything. So we've had to adapt, use technology, get used to using Zoom, and and just sort of working in slightly different ways. So in terms of what's going on in the market, current UK house price growth is at plus 4.1% for the year. Demand for homes year to date is up plus 29%. However, supply is down year to date by minus 2%. So according to the Zoopla Housing Index, sales completions forecast to reach 1.5 million this year, up from 1.04 million last year, the highest level since 2007. The value of sales in 2021 is forecast to be 461 billion. That's up 68% from 2019. So what's fueling this is a shift in people's demand for property. A lot of people are, total stock of homes for sale remains constrained, and there's a shortage of supply to the market. Now, the reasons for this is naturally for new build developers and off-plan developers. COVID has brought with it a number of challenges, that they have to, in terms of safety and security measures on site. Also supply, when borders got shut, material supplies, chains got affected. So they've really had to adapt, and find new ways and new methods of building. But what this has created is a bit of a backlog where less properties or new build housing has come to the market. With as you know, with all investments, when there's a cut of supply but an increase in actual demand and liquidity in the market, with low borrowing rates, we've actually seen an increase in demand, and that's more than likely what's been pushing up the average prices. So buyer demand looks set to ease as the economy opens up, but it will remain elevated compared to previous years, which we anticipate will create one of the busiest sales markets in more than a decade in 2021, according to Zoopla. So lots of demand. On a regional basis, Wales has seen the most growth at 6.3%, and Yorkshire and the Humber at 5.4%. London, very slow. We're looking at 1.9%, the lowest level since March last year. So these are the things we've been saying to clients. We've been saying, look, north, northwest, Yorkshire, and the commuter belt areas around Birmingham and London. And that seems to be where investors are getting the best deals and growth at the moment. So yeah, if we look at the annual housing inflation, plus 4.1%. So it's up 4.1% in the year to April. Prices are being underpinned by demand from buyers continuing to outstrip supply. Price growth is highest in areas where affordability is greater. So affordability has become a major factor. In terms of on a city level, the number 1 and number 2 spot is Liverpool and Manchester. Liverpool at plus 6.9% for the year and Manchester at 6.8%. So they're registering the highest price growth of major cities. And naturally, this is not necessarily city centre. They're talking the city as a whole, the commuter belt areas around these cities. But things need to be considered in terms of certain cities, in terms of the supply and demand as well. But at the moment, that is what the housing index is saying. So lots of activity in the markets. And yeah, sales completions are rising. There's been a 68% rise in value of sales completions, 2021 versus 2019. A lot of this could be due to government stimulus, stamp duty, the stamp duty holiday. So, you know, it could well be due to government incentives, and also the fact that we're in a market in a period where bank rates are almost going into negative. You've got quantitative easing. So, you know, investors do tend to sometimes go to bricks and mortar for sort of a safe investment or commodities such as metals and golds. But yeah, so the hottest and coldest markets in terms of activity, London and the southeast have been taking the longest time for sales to go through, a couple of months, whereas areas in Yorkshire, northwest are taking between 10 or 15 days in terms of the time it takes to secure a sale. Subject to contract and actually exchange. So yeah, so very insightful. We can actually share that report where you can get all the information. And that's generally how the market's performing at present. The latest market trends, we're seeing a shift in buyer demand to, obviously people have been looking out to suburbs like Salford, Media City and Manchester. Liverpool city centre still seems to be good demand. We are seeing a rise in demand for tertiary locations such as Preston, where there's a lot of regeneration going on. The HS2 high-speed rail, which will get you into London in just over an hour. But again, it's all down to affordability and a lot of buy-to-let investors looking for yields. And first-time buyers realising, you know, we don't need to live or work in London anymore. The world's changed. We can live in Preston or Liverpool or Manchester. It's a lot more affordable. You know, there has been a level of economic hardship with COVID, and you know, people's affordability is a key factor which is driving the growth to the north. Trends, we're seeing a rise in commercial to residential conversions. Why is that? Naturally, office space has come to the market recently. There's been a lot of office space come to the market for sale, and developers looking to capitalize on lower build costs effectively, because you know, they won't have to build from scratch and pay the price of the metals and the steel frames and aluminium and timber, which is currently starting to get quite expensive because of inflation. So there's a huge demand for refurbishments, commercial to residential conversions. As a good example, we've got Bishopgate Gardens in Preston, which is completing in August. That was commercial to residential. And also Albion Place in Manchester, which is just on the border of the Salford and the city centre. You can pick up a one bed there, you know, with a car park for sort of 140, 150,000, compared to some of the bigger off-plan towers where you're going to be paying 180 plus for a one bed. So where the build costs are more affordable, the value and the savings can be passed on to the buyer. So we're seeing a trend there. In terms of the property investors are, as mentioned in the Zupa report, and also mentioned on the last webinar, according to Savills, 75% of investors are now focusing on lower value properties, simply because they're going to get a better yield. But one thing I'd say is, you know, you still want to make sure you're buying in a good location where cheap is not always best. You do get some really cheap deals in rural locations. And a lot of people are saying, well, should I be looking in Wales or in other rural areas? But the fact is, people will still gravitate towards the cities or want to be commutable to the cities as we come out of the pandemic and things normalize, because that's effectively where most of the major corporations will still be, and that's where people will be looking to work. So more rising commutable areas to the major cities is what we're seeing. Where are UK property prices heading? In Savills, according to Savills' latest report, Liverpool and Manchester leading the way at 28% growth over 5 years, and then Yorkshire's, there's going to be some good growth there as well. So in terms of prices, nobody has a crystal ball or can sort of predict the future, but what Savills is saying, London 5-year growth 12%, Southwest 18%, but leading the way we've got the Northwest at 28%, and Yorkshire and Humber at 28%. So lots of various markets there, and data, but that's kind of what we're getting from the latest housing index. So nationwide, still a healthy demand for buy-to-let. The mortgage market, I don't know what your thoughts are, James. I mean, with mortgages at the moment, are you seeing a rise in applications? On how
the market is absolutely buzzing. I think most of us probably thought the pandemic, and I know there've been measures from the government to try and boost the market, but I think most of us thought the pandemic would see a negative impact, but I think it's shown how well, the measures have taken, but also how much pent-up demand there's been in the market, because we've been saying it for years now in the mortgage market, let's get Brexit out of the way, let's get the election out of the way, then we threw a pandemic in the way. But that demand has been there, and as you've talked about with the prices, the buy-to-let market is booming at the minute, just because first-time buyer houses are just unaffordable. That's the thing we're seeing in the property market. Wages are going up 3%, but house prices are going up 10%. So more and more young people need to rent, which is a great position for your clients and my clients as well, who are looking to invest. It's not so great for the first-time buyer, but the market is in as good a position it's been in for years.
So you guys are really busy then. And Liam, from your side, applications for people buying property through a limited company, how busy are you guys at the moment?
Busy is an interesting way to put it. Well, to give you some clarity, when we left the office in March of 2020, we were 12. We're now close to 60.
Oh wow!
The reason we're close to 60 is because of the sheer demand we just couldn't cope with. We've had to open up offices in Hong Kong, open offices in Singapore, probably opening one in the Middle East, and possibly even one in South Africa with you as well, Dale.
Oh, great. Look forward to it.
Scale. And we were very nervous, as I'm sure a lot of people in the industry were, about how COVID would affect things. And it's had the opposite effect in terms of a positive one, because from our perspective, I think what's happened is people have been spooked by financial markets and stocks and shares and things like that. And they've seen that their portfolio that they have invested in various shares drop 20% overnight because of these really volatile markets. Whereas property just doesn't do that. No matter if the world's ending or not, people need a roof over their heads. And I think people have wanted to come over towards safe investments, and UK property always has been kind of a bastion of sort of safer and quite well-defined returns. So you might not be making colossal amounts, but you're going to be making safe returns at all points. You don't 20% on a house overnight, essentially. So we've seen things skyrocket.
Excellent. So I think really it's the historic undersupply of housing in the UK. As I said in the last conversation, they need to build circa 250 to 350,000 houses a year, and just not meeting up with the quota. Obviously, COVID had an impact on further restricting supply, and I think the impact of the mass vaccination, now things will open up, people can go do viewings again, and potentially capitalize on current deals. Will certainly have an effect. So we'll move on to the next slide. Thanks for that. So how to build a cash flow UK property portfolio. Now, for us, this is just to reiterate the key points and fundamentals at Fabric Invest, and what we believe in is a clear strategy of the steps you need to take. Obviously, some more seasoned investors may may know this, but we do get a lot of investors from all over, really. Hong Kong, Singapore, South Africa. We're quite new to UK buy-to-let, so they do look for some sound advice from us. So just the key fundamentals for us. Number one, identify your goals and needs by setting out a clear map, a financial goal map. So everybody knows their personal situation, or their financial advisor knows their personal situation. It's always wise to have a diverse portfolio, but for us, identifying what are your actual needs? What is your plan? Have you actually sat down with an advisor and set out a 5 or 10 or 15-year plan based on your current age, when you plan to retire? So really just to find out what your goals are. And that's something we're quite passionate about. Our senior consultants take the time to listen, ask the right questions, and then we can sort of say, okay, well, this property is for you, or it's not for you. Maybe you should rather put your money into government bonds or stocks or whatever else, depending on your appetite for risk. So really getting a clear understanding of your goals, and setting out a clear map of where you want to be in 5, 10, 15 years, how much funds you have available at the moment, and then how you're going to actually get there, I think is very important for anybody, really, whether that's in property investment or business or in life, is just to know if you don't have a clear goal and a written map of how you're going to diversify or build a portfolio, how you can capitalize on leverage. You're not it's like steering a ship without a sail or not really knowing which direction you're going in. So that's something we help with. We have one-to-one strategy sessions, and we actually come up with bespoke reports for our customers and recommendations. So again, what are your main objectives? Is it early retirement, passive income? Are you looking to beat your rates you're getting in the bank? I mean, what are we getting at the moment? It's nothing at the moment, really. So people are getting frustrated. They're not getting anything in the bank, and they're looking to see where they can perhaps capitalize. Say they've got 20 or 30 or 40, or even ideally you want 150, 200,000 pounds to really get a solid portfolio going. But there is an investment for each person, and it just depends on their personal situation and what they're looking to achieve, whether it's short, medium, or long term. Naturally, we recommend property as medium to long term. We don't like to speculate. Therefore, if you are looking for short-term gains, you might be wanting to speculate on stocks or cryptocurrency, which is not having a great time. It's very volatile at the moment. So is property investment the right investment choice? Again, once you've actually really get to understand your goals and what it is you want to achieve, you might decide, well, actually, I want to invest in gold. I just want to put my money somewhere safe. 10 years time, I've seen some good growth. Or I want to put it in bonds. So these are very, very safe, low risk investments. Again, you want to decide what type of property investment's right for you. So you've got HMOs, you've got houses, you've got commercial, you've got retail. So there's various different types of assets you can look at. But for me, if you look at a risk profile on property, we always find that property or apartments near the city centres, close to train stations, close to schools, near the transport hubs, these are the safest. These fall at the bottom category in terms of risk. I would say then if you're going into HMOs or older property, which involves a bit more work and due diligence, you become more of a professional property investor. It will take a little bit more time. You can make quicker gains. You can develop and sell and effectively become a developer, but there is a risk with that. You've got to manage costs, you've got to get the right team, you've got to consider inflation on build materials. So all of a sudden, your profit margins aren't looking as good. So again, we can run through that in detail. Financial planning, raising capital, and affordability. I think I'll give that one to James, if you don't mind. He's a qualified financial advisor and a mortgage expert.
There's one thing I'm qualified to talk about today. I think that's it. Absolutely. I think it's a vital part of all of us working together, which sounds very cheesy, I appreciate. But we need to align it with the goals to understand and actually explain the benefits of leveraging and borrowing the funds against property, because it allows you to, alongside everything else, diversify your risk, take advantage of multiple areas rather than putting all your cash in one investment, for example. So we need to look at everything you're looking to do, not just what's the best 2-year fixed rate out there? Like Dale's been saying, we align it with what's your main objective. If it's to retire early, actually let's spread that risk. If it's just to beat the bank rates or have something short term, actually we look at 2-year rates, etc., etc. So it's not just getting that cheap mortgage, it's actually working alongside Dale and the senior consultants to ensure we have the right goals in mind, not just for the cheap mortgage, but for the properties that you're buying alongside that. So, and we'll move on to the raising capital and other stuff alongside that, because it forms a part of a much bigger picture.
Okay, great. Excellent. So again, you know, planning is important, and what you want to be doing is speaking to obviously the property agents, get on an idea of the properties available, but then also speaking to a mortgage advisor, a financial advisor, and a tax advisor, because you want to make sure you've got the right structure in place, and you also want to make sure you're getting the best possible deal on the finance, and that you're working with the right people that can provide you with the right sort of service on a customer service level. So that's what we try and do. We partner with the likes of James and Liam, and just try and provide a sort of, you know, an approach where everything's covered from A to Z. So yeah, market research, again, that's something I'm very passionate about. We do a lot of market research day in and day out, myself and our project team. So we will go into detail into a city. We will look at the macroeconomics, the population. Where's the population going? Is there regeneration taking place? So Preston, for example, you've got a massive master plan, the Stonygate master plan. You've got the HS2 rail coming in. Liverpool city centre, just on the docks, you've got Liverpool Water Visions, which is a multi-billion-pound regeneration of the waterfront. And then, of course, Salford and Manchester, you can just see what's happening to the skyline and Media City. So again, that's something we're constantly doing, is researching, and then passing on that data and information to the customers. And choosing the right agents or developers to work with. On that front, you want to make sure that they are members of the UK Property Ombudsman. Obviously, for mortgage providers, that they're working with the right mortgage brokers and FCA regulated. So we've got PR cover. We regulated by the Ombudsman and also the Office of Fair Trading Standards. These are things to look out for with agents, and just making sure that they know what they're talking about, and they've done their due diligence, and they're not just trying to push sort of a product on you without knowing all the facts. So I think that's very important. Key fundamentals. So this is what we look at when doing our research. Location, as we've all heard before. What's going on in these areas? Is there regeneration happening? Is there any independent reports provided by the likes of Savills or Zoopla or Rightmove, which can give us some sort of indication of the rental rates and the sales rates? Check the local comparables as well. Demand and supply. Again, we'll look at the statistics on the population in the city, the housing situation, and the occupancy levels on the properties. So if we're seeing cities where there's 96% plus occupancy rates, that's a good indication for us. If occupancies are low, that's naturally a concern. So that's something we'll look at, and also dig out the data from the Office of National Statistics or wherever we have to find it, to find out what the expected demographic is of age. So you'll get young professionals, Generation X, and that's where the tenant demand is. So Manchester, for example, the average age is between 25 to 35. Liverpool's got quite a young average population as well. They've got major universities, so we know there's a good rental demand there from those types of tenants. Local regeneration, as we mentioned, we follow big companies like the Peel Group, who are doing the Liverpool Water Visions. They're responsible for Media City. It's a huge multi-billion-pound projects. And in terms of market due diligence, things that we look out for as part of our due diligence process, key factors would be things like developer track record. We want to work with large established developers who have funding in place. So ideally the developments are fully funded. We only work with experienced developers who can demonstrate a track record, and they've got asset backing as well, and they often keep a portion of the properties themselves within their portfolio. Payment terms, number 2, make sure that you're usually not putting down more than around 20-30% deposits, even 10% ideally, because then you're fully covered by the NHBC warranty. But provided there's a secure legal framework, deposits are normally protected. But yeah, if you have developers normally asking for 70 or 80% before completion, it may mean that they don't have their funding in place. They're fully reliant on investors' cash. And I know that the lawyers are getting quite strict with that now. They do normally require deposit structures of 20 or 30%. Financial advice, seek up-to-date financial advice from reputable advisors or mortgage brokers, just to make sure that you're getting the best possible mortgage deal. And rental guarantee assurances. Now, there's stuff on the market out there. Some of it's good, but some of it's slightly optimistic, where they'll do 5 to 10 year rental guarantees or assurances, as they call them. But just be wary, check the numbers, make sure that the monthly rates are correct, and that the developer or the management company that's promising it, their model needs to stack up. So you need to look at what the market is and the market conditions, and just make sure you check with local agents that the rental that they're promising does stack up, because what I've seen happen is over-promising and not delivering in some cases. And last but not least, number 5, ensuring asset liquidity. Assess likely future demand to plan your exit strategy. So make sure, again, just pick up the phone, speak to some local agents, and actually find out, is there demand for 1-beds? If I buy a 1-bed in the scheme that Dale's talking about, and I come to you guys to sell it, what are you going to charge? And and is there a demand for these types of properties? Because what you don't want to do is end up with an asset, and I've seen people buy all kinds of assets before, student rooms, care homes, and different types of things, but there's no real exit strategy or secondary market on those. So that's something to consider as well. Security, I think we've pretty much covered. On the security side, you need to make sure that the funds are secured within a lawyer's account. You need to make sure the developers have their funding in check. And again, you just need to make sure you're working with reputable people that can provide you with the right assurance, especially if you're buying off plan, because you've got to wait, right? You're buying something that's going to be built in a year or two, and the last thing you want to do is put money into something that's not going to materialize. So again, just make sure that you look out for things such as how the funds are secured and the level of deposit protection that you have in place. Okay, so I think the last one was exit strategy. Again, that goes back to liquidity, where you just want to make sure there's, ask the agent, what is exit strategy? If I buy this property from you, what's the plan in 4 or 5 years? Are you still going to be there to help me sell the property? Can you recommend some local agents that will be able to sell the property? And what's the likelihood of growth? And how long is it going to take me to sell that property when the market's, when I decide I want to exit? So those are the key fundamentals that we look out for on that front. On that subject, I will then hand you over to Liam, I believe, on how to mitigate your tax and maximize your returns by purchasing via a limited company. So we were introduced to Liam. I was introduced to Liam about 2 years ago. Really unique company, that the technology-based company called GetGround, and it just helps people set up efficient, an easy process where they can set up a limited company online, and then they cover everything. So I'll let Liam take the stage, and I hope it provides useful information.
Tremendous. Thank you very much, Dale. Well, pleasure to be in touch with you all. I'm still a bit strange seeing things like this. But it's very much the norm. I mean, I think it must be about 30 or 40 I've done of these over COVID. So it's hopefully I'm getting slightly better at it, but we'll see. But great to be in touch with you all. Again, pleasure to be working with both Fabric and Dicio. I've done a lot of work with those guys over the past year or two. And so what we're going to discuss today is basically a quick fire kind of run through the limited company debate, I suppose. If you're new to property, completely new, this is something you'll definitely come across at some point. If you're already kind of in property, it's definitely something you've either considered or heard about, and it's been one of the kind of forefront topics in the UK recently. And so essentially in the UK, there's two principal ways that you can purchase investment property. You can do it in your personal name. So let's say Lynn's buying a property, Lynn Whittingham buys a property and Lynn's name is on the title deed, or you can do it through your own limited company. So Lynn sets up a limited company and she owns that property within that company by proxy because she owns the company. Now, historically, there certainly has been a certain amount of investors who have used limited companies. However, it's only really in the last kind of 6 years or so it's become really mainstream. So in the past, it was mainly your more mature investors and especially those who were kind of very well capitalized, so buying a lot of property, who were going down that route. But about 6 years or so ago, it started to become increasingly less profitable to be a landlord in your personal capacity in the UK. And so this was basically a result of the government changing certain regulations that hit personal ownership hard. And so Section 24 is one you will have heard, various other stamp duty increases as well. And the reason the government did that was basically to deal with immense tax evasion in the UK buy-to-let industry. So there was a big hole in government coffers. The government wants to push people across the limited company model because limited companies are very transparent. They're UK based. They have audited documents. They have their own legal documents as well. And it means that the government basically gets what they deserve, even though it's actually less typically than what they would get if people are owning in their personal name. And so the principal element of the limited company route that most people are interested in is the tax benefits. And so the guys at Fabric have some tremendous investments on display, and they'll talk about how great the yields are on certain property and how great the return on your investment is. And they are great, but what's even better is ensuring you keep as much of that yield as possible and keep as much of your returns as possible. And so the term I like to use is your real yield and your real return on investment, because until that money's actually in your account, your own personal account, it's not yet been realized. And so what we're trying to do is structure things to ensure that what you have at the end of your investment is as much as possible, essentially. And so I think on the next slide, we're going to be going into what those tax benefits actually are. And then there's also the setup, structuring and management of limited companies. Now, this is an area where a lot of people are actually quite confused by, and a lot of people don't realize that they're confused by it. So a lot of people taking the limited company route will just, jump onto Companies House and set up a company, and within a week or two, it'll be completely ready and they'll be ready to go. Now, when you do that, yes, you have a company, but you have a shell, essentially. A company's value and what it can actually do and the benefits it can bring you is determined by its legal structuring and the quality of its legal documents. And that's something we do to a very high degree. So if we jump on to the next slide, please.
Liam,
Yes.
Can I just mention before you carry on there, sorry to break in and interrupt, but I did notice that you were referring to Lynn, obviously me having property in my name or a limited company, and then you immediately went on to talk about the more mature investor. So I just want to say that didn't go unnoticed and carry on. Next slide, please. As they say.
When I referred to the more mature investor, I meant those who were very good at it rather than actual age, which I'm sure.
Thank you. You've dug your hole. Carry on.
Brilliant. But essentially, so the benefits around limited company ownership. In fact, it's probably best to jump onto the next slide first and then come back to this one now I look at it, if that's possible. Brilliant. So the benefits associated with the limited company route are kind of in two tranches. You have your tax efficiency, so increasing what we actually have in our account at the end of the investment. And then we have a number of other benefits which are on the previous slide, which we'll go on to. Now, the best way to view the tax efficiency is throughout the course of the investment. So from the purchase to the ownership period to the sale. Now, when you purchase using a limited company, there's a number of misconceptions that you pay higher stamp duties when you enter the investment than you would do in your personal capacity. That isn't the case. You pay the same entry fees and the entry costs to an investment using a limited company as you would do in your personal ownership. So there's no real change there. The real changes come when you actually own the property and when you sell it. So the first one here is that when you use a limited company, you can deduct the entire mortgage interest from your UK tax bill. And you can no longer do this in your personal name. This has been replaced by what's called a basic rate credit. And what that means is, let's say we had £2,000 of rental income each month. We had £600 of mortgage interest and £200 of other expenses. When we use a limited company, we can deduct the full amount of those two expenses from our tax bill. So in that case, it would be £800 in total. And so we're only paying tax on £1,200 rather than a much higher amount that we would be due to pay in our personal name. And so this was essentially what was Section 24 a couple of years ago, which means that in your personal name, you can no longer deduct the entirety of your mortgage interest. The secondary element of that is now we've mitigated the amount of money we're paying tax on. We now actually reduce the rate at which we pay tax on it. So we pay corporation tax rather than income tax on our profits. Now, corporation tax is currently lower than any rate of income tax in the UK. So when you use a limited company, you're essentially paying the lowest rate of tax on the smallest pot of taxable income, therefore reducing your overall tax bill and increasing the actual yield that you're actually receiving. Then comes the question of, okay, well, we've got this money in the company. Now, many of us will want to build up a portfolio, so we might allow this money to sit in the company and build up over time, and then we'll reinvest it. But eventually, if not immediately, we're likely to want to take money from the company. So maybe as part of our retirement plan, or just to supplement our income, or even just to live off and be financially free. Now, this is a stumbling block that a lot of investors sometimes mess up on, and they will take their money out of their investment by paying themselves a salary. Now, salaries typically aren't very tax efficient. The reason they're not very tax efficient is that salaries are taxed at income tax rates. You also have to be PAYE registered. There's national insurance contributions to make. And so it's typically not a very efficient route to go. Now, what is more efficient than that is actually, well, there's three particular ways to get your money out. First of all, you can pay yourself dividends from the company. Now, dividends are basically the payments of company profits from the company to company shareholders, which in your case would be you as the investor. Now, when you pay yourself dividends, if you're based in the UK, you get a pretty substantial dividend tax-free allowance. And if you're based overseas, you actually pay 0% dividend tax on the UK side on any dividends leaving the UK. So it can be an even more efficient way to actually extract your money there. However, a lot of UK investors, once they've used up their dividend tax-free allowance, often don't want to pay any dividend tax. And so what they can do now is they can do what's called a director's loan repayment. Now, a director's loan agreement is an agreement set up between yourself and the company that basically says, in Lynn's case, I, Lynn, am lending my company the money to purchase this property. Therefore, my company owes me that money back. And you can repay that money back to yourself from rental profits without any tax on those repayments. So it's a really efficient way of actually extracting your rental profits from the company without any further tax. The third option, and arguably the most efficient, is to pay the money from your company via pension payments. So when you use a limited company, as a director of that company, you can make pension contributions. And those contributions are actually done before corporation tax. And so let's say you have £10,000 rental profits, so you've deducted all your expenses. When you use a limited company and as a director of that, you can pay that full £10,000 amount from your from your company account to your pension pot in advance of tax. And so that when tax is due, you actually have £0 left in your company. And therefore, when corporation tax is applied, well, there's nothing to tax. So your corporation tax bill is zero. Meanwhile, you've got your full £10,000 sat in your company account, your pension pot ready for you to use in the future. And so those are the three principal ways that you would extract your money from the company. But there's also a number of tax efficiencies on sale as well. And these are detailed below. So this comes from the fact that when you use a limited company, you actually increase your means by which you can sell. So you can either sell the property from the company, or you can sell the property by selling the company's shares. When you sell the property by selling the company's shares, you're still selling the property. It's just that now you have this, this shell around your company, or wrap around your company, which is the company's shares. And when you sell that way, you get two big advantages. The first one is the buyer doesn't pay stamp duty land tax on the purchase of that property. So you have a price advantage and can increase the price of that property. And the secondary element of that is because you're selling shares, even though you're selling the property, you actually pay significantly lower capital gains tax on the sale of those shares. So you're basically maximizing your investment returns. So that's a really brief fire through the tax efficiencies. And please, speak to me after or via email about kind of a more in-depth approach on that. But beyond that, there's also a number of other elements to do with limited company benefits. One of the most important ones would be the inheritance and estate planning. So when you use a limited company, you can actually transfer your property via way of shares by gifting them to your children in a way that basically mitigates inheritance tax. So if done correctly, you can actually pay 0% inheritance tax. And for those of you who don't know, inheritance tax in the UK can be very, very high. It's about 40%. You also protect yourself and your investments a lot better when you use a limited company. So you limit your personal liability. And what we mean by that is that should something go wrong with the investment, such as you default on a mortgage, or a tenant sues you, or the roof falls and the insurance doesn't cover it, your personal assets, so your house and your car and things like that, are much better protected than if you owned in your personal name. You also increase the flexible ownership structure of the company as well. So you and your family, or you and friends, or you and your wife can invest together, and you can have different shareholdings in the company and have your investment protected and ensure what you put in, you get out, rather than, kind of coming down to word, trust in somebody's word. And there's also multiple routes to extract your profits, both during the ownership period and on the sale period as well, that are very, very tax efficient. And so overall, there's a whole a number of tax efficiencies and other related benefits associated with limited company ownership. But people are very confused about them. And at GetGround, what we're trying to do is basically educate investors as much as we can. So we have as many consultations with you guys as needed to bring you up to speed with things. And then beyond that, we also facilitate the actual setup and structure of the company in a very high level and specific way. And then the ongoing management of that company. So we set up the company, structure it, then provide a company bank account, both for UK-based investors and those overseas. And then we manage all aspects of the company, so the accountancy and everything else there. And I suppose the big kicker with us is that as a technology company, we can do things at scale and do it very cheaply. So we're approximately 8 to 10 times cheaper than other providers in the industry. Looking after your company for £20 a month, rather than sort of in the region of about £2,000 a year. So you can run your entire limited company with us for £240 a month. And sorry for rushing through that. I'm conscious of time. So I think that's kind of my section done there. Please, anybody ask anything in the Q&A after, or speak to me directly, more than happy to.
Thanks, Liam. So yeah, Liam will, once you've decided, yes, okay, I'm thinking of investing in a property, what we would do is get you on a one-to-one Zoom with Liam, and then he can actually explain in detail how it all works, because it's probably trying to fit in probably 30, 40 minutes into 10 minutes. But yeah, that made a lot of sense. So thanks for that, Liam. Appreciate that. And then we're going to move on to James. So James, we've been working with, he specializes in specifically what we do, which is your sort of off-plan investment properties, commercial to residential conversions, and also more unique buy-to-let investment mortgages, both high street and off-street lending. So yeah, I'll hand over to you, James, and yeah, anything you need, just let me know. Thanks.
Brilliant. No, thanks very much for having us, guys. Thanks, Dale. Before I move on, I highly recommend the guys at GetGround. I'm actually working with Liam myself, so for one of my investments, so it's definitely something that's worth exploring. So one of the key things we're going to talk about today is how to capitalise on the current market that we find ourselves in. We are probably, we've been saying this for about 5 years now, a record low for where borrowing rates are currently, and they can't go down any further, hopefully. So we are in a very, very unique situation where you've got residential mortgage rates well below 1% now. Opportunities, you've got buy-to-let rates. There's actually a buy-to-let rate in the market now at 1%. So rates are at an all-time low. It's nearly free money in some regards. So actually, when you look at the amount of equity that we have got as a country in our properties, because we are a country of homeowners, now is a really, really good time to take advantage of the low borrowing rates. And what that leads on to is good debt versus bad debt. Historically, we are a very risk-averse nation. We don't like taking out debt on our properties, but there's a huge difference between good debt and bad debt. Bad debt is very, very simple to explain. Bad debt is a credit card at 19.9% APR, something that isn't actually creating any wealth for you. It isn't giving you any further opportunities. It's just debt for the sake of having debt. Now, good debt is actually looking to utilize what you have and making the most of it. We've got a really good example on the next page, but good debt is something which helps you create wealth, create income for you. We as a country are sat on, and I mean, it's trillions and trillions of pounds of equity in our homes. And when you look at the opportunity we have with 1%, 1.25, 1.5, 1.75% interest rates out there, and correct me if I'm wrong, Dale, but we've got opportunities to buy to lets at 5%, 6% yields, conservative, I would say, which can, without taking into account the capital growth Dale talked about from Zoopla and Savills earlier at 28, 29%. So actually, when you look at these record low borrowing rates alongside the equity we've got in our homes, that good debt is it can give you a huge advantage to take advantage of the opportunities Fabric are giving out there to their investors and their clients, and start building a plan for you to generate wealth rather than just have your equity sat there doing nothing for you. Because whilst it's a brilliant thing to have no mortgage, having your property paid off, actually, what is it doing for you? What is it actually there for? I appreciate you've got no monthly mortgage payment, but it's doing nothing for you. So actually what we can help our clients alongside Dale, alongside Liam, is take advantage of the thousands of pounds of equity in your home to start making money for you.
Yeah, just as a quick example, James, while we're on the subject, for me, a good debt in buy-to-let investment is your tenant pays your debt, right? And so for example, on Albion Place, which we launched in Manchester, you can get a one-bedroom apartment for £150,000. Your rent effectively per annum, you're looking at about minimum £9,000. Your mortgage repayments at 3% on interest only is £2,249. Less your service charges, your management fee, and your ground rent, you net positive at 5.8%, 4.9%, so £4,900. So effectively, your tenant's covering your fees and also your mortgage, and it covers itself. You don't really, as long as you've got a good tenant in there and it's being managed properly, you're onto a winner. And that's effectively how we structure most of our investments. Thanks, James.
No problem at all. And there's an example cash flow in a minute that we go through, so it's a really, really good one to walk through. We'll walk through it in a minute for you. But also, what we move on to now is talking about actually sourcing the best rates in the market, because again, it's brilliant saying we can get you 1%, 1.5%, but actually it is very dependent on the type of property you're looking at. And why we've been experts in this kind of market for a while is we understand each development is different. We understand some of them are flats above commercial premises. Some of them are off-plan conversions from a concrete original construction in the 1970s. The type of property and everything that is around there is very, very different. And it can lead to very, very different interest rates that are available to you. And leading on to the next point is actually looking at the different types of mortgages that are out there for you. Because we are in a rapidly changing buy-to-let market. Liam will probably know the figures as well, but around about 18 months ago, 2 years ago probably, you were looking at buy-to-let rates for limited companies around 4%, around about 500-600 products out there. As of today, we probably have access to 5,000 products at interest rates at around 2.5%. So the actual opportunities out there for customers is huge now. The market is changing, the types of interest rates are changing, whether you're looking at fixed rates, variable rates, 2 years, 3 years, 5 years, 10 years. There's even now an offset mortgage available to limited company investors. So we have a whole host of products available to you. And the thing I'm really conscious to point out is the difference between a 2-year fixed rate and a 5-year fixed rate currently is the lowest it's ever been in the history of the UK mortgage market. So there's no better time for us to have the conversations and look at the long-term plans and how we structure this. And leading back to Dale's last point, how to ensure your investment is cash positive, absolutely vital to all of this. And I fundamentally agree with the predictions of house price growth in this country going up. We don't build enough houses. That's the fundamental of us as a country. But actually ensuring your investment is cash flow positive is huge. And what a lot of people inevitably do in this country is we look at a repayment mortgage. It's the first thing we do. We want to pay down our debt. We want to ensure that debt is paid off in 25 years' time, and no idea why people choose 25 years. It's just a number someone pulled out of thin air in the 70s. But we always want to repay our debt. Well, actually, you should look at interest only. It doesn't mean you can't pay down that debt. It doesn't mean you don't have the flexibility to pay down that debt, but it just gives you the opportunity to pay down that debt when you see fit to do so. Now, a repayment mortgage straight away will mean your cash flow is, whether it's positive or not, it is dubious. It's likely to be negative in all honesty. Don't get me wrong, you are paying down the debt, but when your net yield is, say your yield's 5-6%, you're paying 2.5%. Why pay down that debt? Every month, if you can bring in, as Dale was saying, £400-500 a month, straight away that can be using that money to invest in another property and build that deposit up, rather than just paying down that debt. When interest rates are so low, it makes no sense. And we'll move on to an example of that now, if you don't mind. Yeah. So one of the key things we do for a lot of our clients is look into how can they grow their portfolio? How can they utilize what they have at the minute to actually invest in new opportunities that are coming up? And we're at a great time to do that, as we keep saying. So we've talked about why to release equity, low interest rate environment. We don't need to spend on that anymore. But taking advantage of your biggest asset. Now, we've got trillions of pounds in equity in this country, so actually utilising that. But also it diversifies your risk. Now, it's all well and good, and it makes a lot of sense to buy property in cash, people think. But actually, that might mean you can buy one property, two properties. Well, actually, if we did a mortgage, you have the opportunity to buy 5 properties, 6 properties, 7 properties. Take advantage of a number of growing areas in the UK to actually diversify that risk away from just one development. Actually, if you have property in 7 developments or 3 or 4 different areas, actually that risk is actually minimalised massively. So let's look at an example of how it works. Let's say someone's got a home worth £300,000 in London. Optimistic, admittedly, in London, I appreciate. I live up north, it's slightly cheaper where I live, but let's say someone's got a property worth £300,000. They've got a mortgage of £100,000 outstanding. Well, let's look at releasing some of that equity. Let's take it up to 75% loan to value. We've got an example there. So releasing 125,000. Now that still means that 75% loan to value, it still means you can benefit from excellent rates. There's remortgage rates available in the market as low as 1.14% if you're taking that equity out up to that loan to value. So you're still getting the best rates in the market there. But what that means is you've now got a further £125,000 there to kind of play with. So you're looking to purchase, let's say, 3 new properties worth £150,000 each. Now, the deposits required, as Dale's saying, don't look to put down 25%. Obviously, a lot less on exchange, but any more than that, I'd be dubious, shall we say. So 25% is 37,500 for each property you're purchasing. Let's factor in the cost of stamp duty of 4,500. So the total amount of cash you require is 125,500. But actually saying, right, James, that all sounds well and good. Actually, what does that mean in real figures? So let's move on to the next page, if you don't mind, Dale. And let's look at an example cash flow. So let's say you buy somewhere for 150,000. Potential rental income in month, reasonable. Let's say £1,000 rental income. You're going to have a service charge each month, £66. Ground rent, £12.50. You've got a management charge for looking after renting out that property, which I think 8% sounds realistic. And then you've got a buy-to-let mortgage to take care of. So you put your 25% down, so you've got a buy-to-let mortgage at 75%, so that's £234 a month. Let's then look at a residential mortgage releasing equity. There's 1.24 fixed for 5 years. It's unbelievable. The monthly payment on that would be £129. So the total profit, after taking into account all of them costs, is £479 a month. Now you've not put up, well, you've actually put £500 cash in, but let's say you've got that back after month 1. You've realistically put very, very little, if no cash in. And each month your profit is £479. Now annualise that across the 3 properties you're purchasing, that's £17,244 from actually putting no cash in whatsoever. So when people say to me, it's a risk releasing capital from my property, I don't see why I do it. The numbers just make so much sense and allows you to actually take advantage of the low borrowing rates and the cash you have in your property. So this is what we're doing month in, month out with our clients. And actually, when you look at them numbers there, it's not just made up numbers. This is an example I've actually done for a client of mine. It's not just me plucking numbers out of thin air. It's an example we've done with a client where they put no cash in and that's their annual profit. And they have set up the companies with Liam as well at GetGround. So yeah, it makes a lot of sense.
Thanks, James. That's brilliant. So effectively, you've even got me thinking, because I've got a property close to London. I've got quite a lot of equity in there, but I'm not, sometimes, especially at the moment, not everyone's cash rich, right?
No.
And
I wish I was.
Yeah, and people are kind of also reserved because of COVID. But what a lot of people forget is they're sitting on properties that they currently own. And as long as they're strategic about it and they look at the numbers properly and they're not putting themselves in a financial risk of being able to repay their mortgage or whatever, it's a great way to look at even a great time to even look at remortgaging. A lot of people are sitting on higher interest rates that they've not actually gone back in on, and you can get a lower rate, you can release equity, and then you can use some of that equity to buy a property up north in one of these areas. So yeah, that's very interesting. Thanks for that.
No problem.
Great. So Lynn, I'll hand it over to you for the Q&A. So yeah, anyone who's got any questions for us, fire away. Yeah, I'll hand it over to you.
Lovely. So first of all, I want to say, you know, I'm always sitting and go, wow, by the information that our presenters give to us. And this time it's no exception. So thank you, Dale, James and Liam. Extremely informative, massive value, very much appreciated. And I know certainly, James, you definitely hit on something there that I know Mr. Whittingham in the background here is going to be saying, I told you so. We spoke about this only yesterday about interest rates and interest-only mortgages. So thank you for that. So if you have joined us partway through, no worries at all. Just a reminder that you will receive the recording of the webinar via email, so you'll be able to watch it back. And there really has been a lot of information here. As the guy said, you know, it's very difficult to cram what they have information-wise for you into their 15 minutes. So yeah, we do urge you to have a look at that back. So I'd invite you now to all stay on. If you've got any questions, please do put them in the chat. Direct them to me if you would, and if you can say if your question is directed to Dale, James or Liam, that would be hugely beneficial. Please do remember that you'll have access to a free gift at the end of the Q&A. So I urge you all to stay on. And of course, there are always great benefits to be had from other people's questions. So let's just go through the questions. Actually, I will just say, just flicking through here, as several of you have said, will the slides for the presentation be available after? So yes, no problem at all, Dale, if we can just include that in what we send over to people, that would be great. And believe it or not, this is the first time ever. I mean, I've got to say, we normally got so many questions. We're going back to people after the webinar, but I think you guys have done such a great job here that I've actually got no questions. So if you have got anything, just pop it in the chat, as I say now. But Dale, perhaps we'd like to go straight to the free gifts then.
Yeah, so
bear with.
We've got one.
Yeah, well, we've got a few. So I think it was slow on the tech. Actually, they're long questions. So right, okay. So let's see, what have we got here? Right, so this is my first webinar with any property group, including Fabric. So this was very overwhelming. When can I be directed to do further research on this? Dale, would you like to answer that one?
Yes. So what we'll do is arrange for one of our senior consultants to contact you at a time that suits you, and they will be able to provide you with the market reports. I know we've given you sometimes information overload on these webinars, so they take your time. You can speak to them, and they will provide you with the information we've covered in the presentation, also the mortgage information, and setting up a limited company information. So yeah, we've got a very good process in place where you can get a consultation and they'll guide you in the right direction.
Yeah, no problem at all. I've got your contact details there. I like to keep people's names private here, so excuse me if I don't mention your name. It's not because I can't see it, or I don't want to advise you personally, but I've got your details here. So yes, indeed, we'll get one of our advisors to contact you over the next couple of days. So James, the next one is for you. Can you assist with securing a mortgage on buy-to-let properties with a 25% down payment and 75% loan to value for non-UK residents?
Yeah, absolutely. We have a number of clients who are based overseas. We have a lot of options available in that market, actually, including private banks, private lenders, men using my background. So yeah, more than happy to help with all of that. There's a number of points I'd say. It's definitely worth a chat with Liam as well, actually, because it makes a lot of sense to do that. But yeah, absolutely, we can secure that, and rates have come down considerably for non-UK residents in the past 18 months. Yeah, more than happy to help.
Lovely, thank you. And I think we'll stick with you, James, for the next one. I am currently out of work, but I have a property in London with a lot of equity. Also, can I release equity if out of work?
In theory, yes. Of course, it depends on personal circumstances, and we need to look at the bigger picture to understand whether that property is one you live in or one you rent out currently. Because if it's one you rent out, absolutely no problem. Because buy-to-lets are generically based on the rent you bring in rather than your personal income that you have. So the answer is yes and no, which sounds like a politician's answer, so please forgive me, Lynn. But yes, we can do that, but it is obviously very much based on personal circumstances.
Yeah, I mean, we can arrange a call with you there, James. They're also saying they do have some savings, which of course is an added bonus there. Sorry, I was waiting for you to comment.
No, yeah, absolutely. Sorry, I wasn't sure then.
Late in the evening.
Yeah, obviously, the better financial picture have in the background, the better picture we can present to lenders. So yeah, that makes a huge difference.
Yeah. Okay. Do you think that the interest rates will rise over the next 6 to 12 months?
Here we go. Here's the £1 million question that can make me a very rich man. Do I personally? No, I don't. Inflation has seen an increase up to about 1.5% the last time we did it. But what we've got to remember is we're coming into the biggest recession in probably any of our lifetimes. We've seen GDPR fall dramatically. We've not seen the impacts of the furlough scheme actually ending as of yet. Furlough is still in place. We've got lots of quantitative easing. The stamp duty is about to end. So I think people who think rates are all of a sudden going to start going up because of inflation are a little bit premature. So do I think they'll rise in the next 6 to 12 months? Probably not. Will they after that date? Potentially, but Dale will remember the 2008 property crashes when I got into this industry. Interest rates haven't risen from that recession. So we've just had another one since then. So are actually rates going to rise? Maybe. Will they rise massively? Absolutely not. I don't think anything for at least 12 months personally. Beyond that, if they do, it will be very, very slow.
I think as well, you know, being somebody, show my age again here, who bought in 1988, I can't see ever hitting that kind of high. But you know, shouldn't say that out loud, should I? So, do you also can you get mortgages for overseas investors for somebody particularly in the Middle East here?
That I'll be honest, that's where the majority of my overseas client base is, in the likes of Dubai, Qatar, Bahrain. So yeah, that is a hotbed for investing in the UK, shall we say. So yeah, I'm actually going over to Dubai later this year and in the Middle East for some of our clients. So yeah, absolutely.
Right, okay, lovely, thank you. I've excuse me looking in different directions, but I've got messages coming in from different directions here. So can a new limited company get finance? Liam, I think that's for you.
Yeah, I think that's a joint one. And yes, is the truth. There's a bit of a misconception that a company needs, you know, lots and lots of kind of proof of trading over the years. In fact, trading companies typically struggle to get competitive financing, and they typically have to lean more on commercial loan markets. When you take the limited company route, you create what's called an SPV. It's a special purpose vehicle, and it's a company that exists purely for buying and holding investment property. And this is what mortgage lenders want you to have. A new one or an existing one isn't an issue. It's what they're actually looking into is that the UBOs, the ultimate beneficial owners in the company, which are who's behind it. So the people they're looking at are actually the shareholders and the directors rather than the company as an entity itself. I think James will clarify this as well. Limited company mortgages are a bit of a funny one. They're almost personal name mortgages, but with kind of a different guise on them. So they'll still credit check you. There'll still be minimum income requirements. But it's not an issue if it's brand new or not. So we've got about, we work with about sort of 3,500 investors across the planet, all of them with typically multiple SPVs actually, and all of them are brand new because part of our actual service is the creation and structuring of them. And I would say of those 3,500, maybe 90% of them are mortgage buyers, 10% are cash buyers, and all of those 90% have mortgages. So financing's not a problem there, but James will be able to elaborate there too.
Yeah, completely agree. I actually had a mortgage lender tell me today they prefer new companies, which sounds so daft, but just because they know they've been set up correctly now. Whereas when this market kind of boomed originally, should we say 2017, companies were just set up willy-nilly, not correctly. So actually we know through the likes of GetGround that they're set up correctly. So yeah, absolutely no problem, because they're not, as Liam said, they're not underwriting the company. They're looking at the individuals behind it, but probably even more than that, they're looking at the property they're buying. They're looking at, is it quality properties like the ones Fabric sell with good rental returns in a good building, which is good construction. That's what they're more bothered about rather than how long the company's been going. So yeah, absolutely no problem with that.
Thank you, guys. So a question here about liabilities. Do I have to sell my house to pay the liabilities because the property is belonging to company assets?
I think the question that's probably being asked there is, in fact, Lynn, could you repeat that again, please?
Yeah, so it says, do I have to sell the house to pay the liabilities because the property is belonging to company assets?
Right. I'm trying to get my head around that one. I'm not sure.
Confusing question.
Yeah.
I think what they mean is the shareholding. You sell the property to. I mean, what do they mean by the liabilities? That maybe they can rephrase the question.
Yeah, if you could.
I can't tell if this is because this could be potentially be a question around, you know, if something goes wrong with the investment, do you have to sell your house to pay off the liabilities of the company? So if you hold your property in a limited company and let's say a tenant sues you or something like that, or the roof caves in and you can't afford it, can a lender or can a bailiff or somebody come after your personal assets? If the question is about that, which it potentially might be, you're much better protected. Unfortunately, due to a million different legal reasons, your liability is never completely protected, but the general point is you're more protected than you would be in your personal capacity. A lot of lenders, if you go down the mortgage route, will ask you to take out a personal guarantee.
Yeah.
It basically means that you cover the property costs, or if anything goes wrong with the investment in the company, that you as a director will cover it. Whilst personal guarantees do definitely penetrate the liability shield, you're still more protected. The reason for that is sometimes personal guarantees can be very difficult to enforce. They also have to be proved in a court of law, and that there's some interest in legals around that. If they are proved, what it forms is something called a non-collateralized debt obligation usually, which basically means that a lender or a bank or somebody coming after your assets can only really touch assets that don't have debt on them. So if you've got a house with a mortgage or if you've got car and finance, it's much more difficult for them to touch that than debt-free assets, essentially. So again, yes, you know, your liability is never completely protected, but you're more protected than you would be in your personal capacity. Doubly so if you're a cash buyer. So if you're not purchasing with cash with a mortgage, you're still much more protected than you would be in your personal name.
Lovely, thank you, guys. So for the person who asked that question, don't worry if that's not the right answer. One of our advisors will give you a call over the next couple of days and just make sure that we've clarified your question here. So just moving on, I've got another one here for you, Liam, if you don't mind. So if you have already bought buy-to-let properties in your personal name, are you able to switch them to a limited company? Good question. Lots of people ask that out there.
The eternal question. It's, oh God. I wish I had a better answer for you, is the truth. So yes, you can. Yes, we can facilitate it very easily. Yes, we have lots of investors who do it. How financially attractive it is a different matter. So the principal issue is that when you own property in your personal name, you as a legal identity own that property. A company is also a different legal identity, so it's not related to you. So when you transfer the property from your personal name, so one legal identity to another, it's viewed by HMRC as a sale. And so what it usually results in is capital gains tax and stamp duty land tax. And that can be very, very costly. So if there hasn't been much capital gain on the property and it's only stamp duty land tax and it's a relatively low value property, sometimes it can be worth doing. But typically, let's say you've had a property for 10 or 15 years, you've had some fair amount of capital growth on it, you've also got, a high SDLT on it, it can be very costly to transfer it. Now, there are various accountants and tax advisors out there that promise that you can transfer your property over to limited company, without paying those taxes or without paying one of them. Now, some of them are correct. There are some very complex and intricate ways where a situation where if you're in a formalized partnership agreement with somebody, sometimes you can mitigate some elements of that. A lot of them are cowboys and promising the world. Some of them are promising very, very complex routes that HMRC can very easily come back again to say, hang about, this is ridiculous. Pay us 30 grand in capital gains tax. And some of them, the cost of actually doing that sometimes usurps the actual cost of what you would pay just to transfer it normally. So the general rule of thumb is that it's usually very challenging. There are occasions where you can transfer without SCLT, or you can qualify for capital gains tax relief or something like that. But they're very few and far between. The point you've got to remember here is that the government isn't inclined to make this easy for people, is the general point. And so the rule of thumb is that for any future property, it's usually wise to buy it in a limited company. So you keep your property you hold currently in your personal name. But moving forward, you would buy any more in a limited company. But again, it usually is a case-by-case basis, but on average, it's very costly to do so.
Thank you. So this is actually for both of you. So how soon to set up a company and get a mortgage?
Great. Well, I would say it's probably a bit better to, and James said this too, probably best to check in what your mortgage options are first. Typically, the interest rates between limited company mortgages and personal name mortgages are not far off net recently. They're getting closer and closer to it. Any difference is usually discounted by the fact you can deduct your full mortgage interest, so any difference there is accounted for. I would definitely say speak to James or a broker first, figure out what options are available for your situation. Then decide on the property you're going for. And then once you've kind of said, right, this is the route we're going down, that's probably the best time to set up. So what I know the guys at Fabric do is, they'll have a client reserve a unit and say, right, they're interested in taking the limited company route, or they'd like to know more about it. We'll then have to make consultations necessary, set up the limited company, possibly refer over to James, or James may have already spoken to them, and then that'll be the process there. And then you would exchange in the name of the limited company. The important thing to understand, though, is it's important you do set it up before exchange so that you can exchange in the name of the limited company.
Yeah, that's the key. Sorry to jump in, but yeah, I'd always suggest, and as I would suggest, wouldn't I, do the mortgage before the limited company, just because we can build the cash flows out and work with clients. Once you've found that property, I'd never say do the limited company before you found a property. We can now apply for the mortgage, found your property. So work with Dale and his senior consultants to find that property. Let us build out them cash flows to provide you with the options. So when you speak to them, you know what your mortgage options are and the costs of both are before you go down that route.
Absolutely, thank you. And somebody here is asking, what process for international investors to purchase property in the UK?
Yeah, I could take that one, Lynn. Mm-hmm. So yeah, the process is very straightforward. In fact, we're about to release a buyer's guide, which will explain the process in detail. And effectively, we can help step by step to guide you to the property, present you with all the information. The first step number one is to book a call, or even better, a Zoom, face-to-face Zoom with one of our consultants. They can explain the process to you. The second step is once they've got an idea of your goals and your requirements, we can then recommend the right properties to you. Once you've decided on a specific property investment, the process then is quite simplified. You just fill in a reservation form. The form will be transferred along with a deposit, usually can range from £2,000 up to £5,000. That will secure the property for you. While that process is taking place and we're getting the contracts out, you can speak to the mortgage broker, James, and also Liam about setting up a limited company. We can then show you whether it's going to be best to go down the personal name route or whether you want to go down the limited company route once you've got your head around that. But the next steps, the contracts will be released. Everything can be done online these days. You don't have to go to the UK. We can do all the notarization, all the anti-money laundering, the mortgage process, and also the exchange of contracts normally take place within about 30 days from reservation. So things have become quite convenient in that sense, that the lawyers and mortgage brokers and companies like us have taken advantage of technology, and yeah, everything can be done online from the comfort of your home, or we can arrange a viewing if you want to come over and see the properties before you purchase. So yeah, there's no restrictions for overseas investors, but do be aware of the UK taxes and the UK laws, just so you understand how it works and how it'll affect your net yield effectively. So it really varies depending what country you're from, if there's a dual taxation treaty. So there's factors to consider, but you'll need to look at things like income tax threshold. But the process is really simplified, and we can guide you step by step if you just get on a call with one of our consultants.
Just to add one thing there as well. Sorry, Lynn. But around kind of technology and things like that. One, especially for those based overseas, and I think there's quite a few of you on the call. One of the things you'll need for a mortgage, both in your personal name and in a limited company in the UK, is at least definitely for a limited company in the UK, is a business bank account essentially. Now these are typically very difficult to get for overseas investors. It usually requires you to come to the UK and do a number of things here, and even then it can be challenging to actually get them. We have managed to work out a very kind of unique solution to this for international investors from most countries. There's only about 30 countries we can't work with, where we can basically provide an account as part of our service on the platform. So you'd have your GetGround account with your limited companies in it, but you would also have your company's financial accounts there as well. So you can qualify for mortgages, get the best rates. You can also receive rental income. You can transfer it back to yourself internationally at competitive exchange rates and things like that. So again, we're trying to use tech to make it as easy as possible for international investors to get involved without having to spend tens of thousands coming back and forth to the UK from Hong Kong or Dubai or wherever you might be in the world.
Absolutely. Thank you, Liam, for adding that in actually. And I personally have worked with several of my clients and passed them to Liam to speak to them about doing exactly that. So it's well worth a conversation with Liam if that's something you're looking at. So I'm just going to do 2 more questions, guys, because as I said before, we're respectful of people's time. So just to do a couple more. Question for Liam or James: who would be best to review, check any buy-to-let rental analysis we have currently conducted on potential purchases?
Potentially me. I think James will definitely have some very useful insights there as well. Where I would probably be able to come in a lot better is understand kind of your actual post-tax situation and your kind of assumptions. So especially with mortgage interest relief and things like that and basic rate credits and whatnot, people can get a bit confused around that. And so we have some very kind of highly specified tax investment examples. For example, we've got one for £200,000 property, a 300,000, a 500,000, one for one based overseas, one for one based in the UK, which have really good breakdowns of kind of every level down from your yield coming in to what you actually get out at the bottom. So we can definitely provide some of them and take a look at your situation. But James will definitely be able to give you an idea on the mortgage. Maybe you're thinking you're going to be paying much higher in terms of your mortgage rate than you actually might be in reality. But I think both of us to a degree.
Yeah, I'd even add Dale to that. I think we can all just get everyone involved. Why not? I think that's the key to this is getting people involved. I'll look at it from a mortgage perspective. I'll happily look at it from a cash flow perspective, just with my financial eyes, similar to Liam, but I'll probably put a different perspective on it. But similarly, I think Dale and the consultants at Fabric can probably look at it from assessing the yield, assessing the opportunity, and ensuring that it's the right one for you and your goals. I think that's the benefit of working with likes of myself, Liam and Dale, is we'll work as a team to look at it rather than just get one person. Let's get all 3 of us involved to look at it from each of our own niches, shall we say.
Yeah, we would, on the question, I think you mentioned rental analysis, Lynn, we'll actually get the rentals checked by some local letting management companies. So we'll get independent rental valuations from the local companies. And then we'll also do some comparable analysis as well. So all the numbers we give you are the current market rates. And then you can work out, once you've spoken to Liam and you understand what your repayments are going to be, you can work out the rentals versus the repayments, and also the costs such as the management fee, the service and the ground rent.
Thank you, guys. So the last one actually is not a question, but someone said here, this session is an eye-opener for me. The presenters did a fantastic job. I would definitely be in touch with presenters to move forward. So thank you for that. That's always lovely to have some good feedback there. So we do try and give massive value, and I say massive value because it's never just value. You know, I sit on a lot of webinars, and that, as I say, it's a privilege to host the Fabric Property Group ones, but they really do give a lot of value. So any more questions, then please do just send them in and we will get back to you afterwards. So Dale, would you like to just go forward and tell us what the gift is tonight, please?
Yeah, sure. So we've just released recently our latest UK investment guide, and we've also got a location guides available for the areas we discussed that we were referring to, Liverpool and Manchester. So that's the free giveaways, and then also a strategy session where you can actually book an appointment. I would highly recommend booking an appointment with one of the senior consultants. Each one of them have over 10 years property investment experience. It's usually around a 20 to 30 minute Zoom session where they'll get to understand your goals, requirements. They can also then put you in touch with James for the mortgages and Liam for an appointment on setting up a limited company. So that'll be an advisory service that we offer. There's no obligation. We just want to understand your current situation and see if this is something that is of value to you. And then the other one would be, obviously the incentive would be for the guys to get on a Zoom with Liam or James to discuss their financial situation and explain further the process of setting up a limited company or getting a mortgage. So that was it. But I also wanted to mention we are currently doing a referral fee program. We've recently offered a referral fee incentive. If you've got any, maybe you're not in a position to invest right now, but you've got friends or family who may find some value in what we're offering. We're paying a £1,000 referral fee if you've got anyone you can recommend to us. So yeah, thanks for watching, and we hope that was useful.
Thank you, Dale. So, ladies and gentlemen, what always makes me laugh at this point is I say to Dale, he says to me, I'm going to give away something tonight. So, okay, we'll give away a free gift. And then we get to it, and on the night he says to me, send me a text actually a little while ago, just say, I think I'll give away a couple of things tonight. And very quickly it moves to 3, and then no, actually it's 5 in there. So thanks for that, just to confuse things.
Yeah.
So, okay, what I'm going to ask you to all do then, please, if you would like the UK investment guide, or indeed one of the location guides, please put guide in the chat now. If you would like the strategy session with one of Fabric's property consultants, please put strategy in the chat. And if you'd like a free one-to-one consultation with James or Liam, please put James or Liam in the chat. And just to add in there, if you are interested in the referral fee program, then just add in referral into the chat. And we will come back to you over the next few days and have a conversation with you just to clarify. But if actually you'd like the whole lot, you're thinking, do you know what, we don't get this many freebies in one go, then just put bundle in the chat. That makes your life easier. So yeah, please do that, and we'll look forward to speaking to you. So as I said, if you've got any other questions at all, please contact your dedicated property consultant at Fabric. As Dale mentioned, each one of us has a minimum of 10 years experience and in the property industry, and they'll be more than happy to jump on a call or a Zoom with you. So I can see lots of you are sending in here messages as to what you'd like, that's no problem at all. We'll get those off to you. So Dale, James and Liam, I just want to say on behalf of everyone here, a huge, huge thank you for your time and valuable knowledge this evening. Very much appreciated as always. I want to thank everyone here for joining us today. Truly appreciated. Stay safe, stay well, and we look forward to seeing you again. Take care.
Thanks, Garth. Thanks, James, Liam. Thanks, everybody. And have a really good evening. Take care.
Cool.
Cheers, guys.
There you guys.
Thank you.